Silver is at $63.95 right now as this video goes live on the morning of Wednesday, June the 10th, 2026. This is the lowest price silver has traded at since March the 23rd. The FX Leaders analysis published this morning, specifically this morning, has a $58 target in the headline. Goldman Sachs just pushed every 2026 rate cut to 2027. An American helicopter has been downed, and the United States has launched new strikes against Iran, which is pushing oil higher and driving silver down simultaneously because the market is processing the inflation from oil prices signal before it processes the geopolitical safe haven signal. And somewhere in the middle of all of this, the single most expensive investment behavior available to any silver investor right now is playing out in real time across every forum, every chat room, and every group of investors who have been watching this metal since January. They're waiting for $60. Not because $60 has any specific technical justification that $61.02 does not have. Not because the structural supply deficit changes between $64 and $60. Not because Goldman Sachs or UBS or Deutsche Bank or any institutional analyst has identified $60 as a meaningful price level that changes the investment case. But because 60 is a round number. Because the bears who have been correct so far have now extended their targets to 58 from 62. And because the psychological comfort of saying, I will buy at 60 is vastly greater than the discomfort of buying at $63.95 when the price is falling and every headline is bearish. And by the time you finish watching this video, you are going to understand why waiting for $60 is the single most reliable way to miss the move that the structural case, the physical demand data, the institutional target distribution, and the historical pattern of silver bull market corrections are all pointing toward. Not because silver is going to $65 tomorrow, it might go to $60 first, but because the specific behavioral trap of waiting for round number precision in a volatile commodity market has a documented historical record of producing one outcome with near perfect consistency. The investors who waited for the perfect number watched the move happen without them every single time. Stay with me. Because the pattern of what happens when the consensus is waiting for a specific lower number is one of the most important and most ignored dynamics in precious metals investing. And it is operating right now with a precision that the current market setup makes particularly visible. The four-stage pattern governing investor behavior during the washout phase of a bull market correction follows a sequence that behavioral economists have documented across every major asset class in history. Stage 1 is the first major peak and the formation of the waiting intention. After a dramatic advance, the asset corrects, and investors who did not participate in the advance form a waiting intention, a specific lower price at which they will buy. The waiting intention feels disciplined. It feels like the opposite of the impulsive buying that drove the speculative excess at the top. Stage 2 is the approach and extension. The asset approaches the waiting price. As it gets close, the bears who called for that level become more vocal and extend their targets lower, convincing the waiting investor that their target was not low enough. Stage 3 is the pivot. The asset reverses without touching the waiting price, or touches it briefly and reverses so quickly that the waiting investor cannot execute their buy before the market has moved away. Stage 4 is the miss. The asset advances past the waiting investor's original entry intention. The waiting investor, having been patient for weeks or months, now must choose between buying at a higher price than they decided not to pay earlier, or continuing to wait for the next pullback, which in a structural bull market may or may not arrive. Historical proof number 1, March the 18th through August the 7th, 2020. Silver falls from approximately $18 per ounce in late February to $11.77 per ounce on March the 18th, 2020, as pandemic-driven forced deleveraging compresses every asset class simultaneously. The fundamental case for silver has not changed. The silver supply deficit is still structural. Industrial demand has temporarily disrupted, but solar, electronics, and medical applications are not going away. The monetary policy response to the pandemic is going to be the largest Federal Reserve balance sheet expansion in history. The case for owning a real asset in an era of massive money creation is stronger in March 2020 than it was in February 2020. But silver is at $11.77, the lowest it has been since 2009, and the headlines are catastrophic, and the consensus is waiting for silver to revisit the 2015 lows near $14 after correcting through them on the way down, and then potentially testing the $10 and $12 range that had marked the base of the recovery from the 2011 crash. $11.77, investors waiting for $10 or $12. On August the 7th, 2020, silver trades above $29 per ounce, from $11.77 to $29 in 142 days. a 146% gain. The investors who bought the $11.77 crash are sitting on gains that permanently separate their portfolio performance from everyone else who tried to invest in silver that year. The investors who were waiting for $12 or $10 never got back in, because when silver reversed from $11.77, it reversed with the speed and violence that only a short covering cascade on top of genuine physical buying produces. The sessions that mattered most happened in days that moved 5, 8, and 12% in single sessions. Anyone waiting on the sidelines for confirmation that the reversal was real missed most of the move before they decided it was real enough to act on. Historical proof number 2. August 2018 through September 2019, gold corrects from approximately $1,360 per ounce in April 2018 to $1,174 per ounce in August 2018, a 14% decline from a multi-year high. Gold investors who had been waiting for the pullback to buy now shift their waiting target lower. The 2015 low of approximately $1,050 was the established structural floor from the prior bear market. It had not been tested since. The majority consensus among retail precious metals investors by late 2018 was that gold needed to test $1,050 before the real new bull market could begin with confidence. It needed to prove the low was in. It needed to verify that the 2011 to 2015 bear market was genuinely over and not merely paused at elevated levels. $1,050. That was the waiting number. Gold proceeded to spend the remainder of 2018 and the first 7 months of 2019 trading between $1,174 and $1,366, never touching $1,050. On August the 27th, 2019, gold broke above $1,550, entering territory it had not occupied since 2013. By August 2020, gold was above $2,000. By January 2026, gold hit an all-time high of $5,589. The investors who waited for $1,050 never bought. The investors who bought at $1,174, the actual market low, even though it looked uncomfortable and felt premature, returned approximately 376% by the time gold hit $5,589. The waiting trade cost them the entire run. Historical proof number 3. The 1973 to 1976 silver correction and the waiting investors who missed the decade's greatest commodity trade. From late 1973 to early 1974, silver surged approximately 125% in a matter of months. The first leg of the 1970s bull market. Then over the following 2 years, silver fell approximately 45% from that first peak. This is a number that should feel familiar because it is almost exactly the decline that silver has registered from $121 in January 2026 to $64 today. 45% from the first peak. The investors in 1974 who had missed the first 125% leg looked at the 45% correction and said, when it falls back to where it started, when it gets back to the level that preceded the entire first leg, then I will know the bull market is real, and I will buy with confidence. Silver's starting price for the first leg in 1973 was approximately $3.80. The 45% correction from the first peak took silver to approximately $5. The investors waiting for $3.80 never got it. Silver spent approximately 2 years between $4 and $6 before beginning the second leg. Then it went to $50 by 1980. The second leg produced returns of approximately 10 times from the correction lows. The investors who bought at $4 to $6 made 10 times their money. The investors who waited for $3.80 made zero. The pattern is the same pattern. Different decades, different levels, same behavioral dynamic. Wait for the comfortable number, miss the move. Check. Verified. Undeniable. Now, apply the pattern to the specific case of silver at $63.95 this Wednesday morning, and the specific reasons why the waiting for 60 dynamic is creating the setup for the miss. Here is the current market structure in precise terms. Silver has been declining from its January 29th all-time high of $121.64 for approximately 132 days. In that time, it has declined 47%. The decline has been driven by 3 documented forces: leveraged speculative paper market liquidation, solar demand thrifting at extreme prices, and the reversal of rate cut expectations following blowout May jobs data, and Goldman Sachs' decision to push all 2026 rate cuts to 2027. These 3 forces have been extensively documented in the mainstream financial press, which means they are now priced into the consensus. The FX Leaders forecast published this morning is representative of the bearish consensus. $58 target, aggressive liquidation by commercial derivatives desks, short side positioning recommended. This is the consensus right now, not a minority view. The consensus. And here's the specific problem with the consensus. The $58 target FX leaders published this morning is based on a bear case that has three components. First, continued CPI heat that reinforces rate hike fears and dollar strength. Second, further Middle East escalation that keeps energy prices elevated and complicates the Fed's easing timeline. Third, continued paper market deleveraging as commercial derivatives desks reduce long silver exposure. Each of these three components is currently active. None of them is guaranteed to continue at current intensity for the next 2 to 4 weeks. The CPI data releasing this morning is the first major test. If it prints at or below 4%, the rate hike fear narrative partially dissolves, the dollar weakens, and the paper market's motivation for continued selling reduces significantly. The FX leader's $58 target assumes a hot CPI. A cooler than expected print eliminates the primary short-term catalyst for the continued decline and creates the conditions for a sharp reversal from current levels, potentially in the same session where the CPI data releases. But here's the deeper issue with waiting for $60 that goes beyond the CPI data point. The specific technical level that the March 23rd low established at $61.02 is the structural line, not 60. The March swing low at $61.02 is where the Elliott wave analysis identifies the completion of wave W in the corrective structure. Breaking that level triggers the cascade toward the $38.70 projection. Holding that level allows the corrective pattern to complete and the bull market to resume. $61.02, not 60. Investors waiting for $60 are waiting for a round number that sits halfway between the structural support and the price that triggers the bear cascade. At $60, if you're a buyer, you have already absorbed one additional dollar of decline from $61 without any confirmation that the structural support has held. And if 61 fails and the cascade begins, you're buying into the beginning of the cascade rather than at the structural floor. The waiting for 60 logic inverts the technical setup. The correct position is closer to 62 to 64, where the risk reward, with a stop below 61, is approximately 3 to 4 times reward for every $1 of risk. At $60, the stop placement is unclear because you are below the structural reference, and the downside target expands significantly. Here is the institutional consensus structure that the waiting investors are also misreading. UBS, the most bearish major bank covering silver, has an $80 year-end target. That is 25% above the current price of $63.95. JP Morgan projects an $81 annual average with the explicit acknowledgement of potential for significant overshoot during strong inflow periods. Deutsche Bank targets $100 by year-end. Citigroup targets $110. Bank of America has a target range of $135 to $309 in bull case scenarios. Goldman Sachs, the same Goldman Sachs that just pushed rate cuts to 2027, has not issued a silver bear case that calls for $60 or below as a year-end level. The Goldman rate cut delay is a negative catalyst for precious metals timeline. It is not a negative catalyst for the structural supply deficit, the physical demand, or the long-term price direction. Goldman saying no cuts until 2027 means the monetary tailwind is delayed. It does not eliminate it. And the most bearish bank's year-end target of $80 is 25% above where silver trades today. If every institutional analyst, from the most bearish to the most bullish, believes silver will be higher by year-end, and the current price is $63.95, then the waiting for 60 trade is asking the investor to be more bearish than the most bearish institutional analyst covering the asset. That is not a conservative position. That is a contrarian position against the full distribution of professional opinion in the direction of further decline. Here is the physical market data that the waiting investors are either unaware of or discounting. The People's Bank of China purchased gold for the 19th consecutive month. This is not a trading strategy. This is a structural allocation by the world's largest accumulator of monetary metal assets, operating continuously for 19 months, regardless of month-to-month price fluctuations. Physical coin and bar demand in the first quarter of 2026 was 474 metric tons, the second highest quarter on record, up 42% year over year. These physical buyers were not waiting for $60. They were buying at $70, at $80, at $64. The physical market is not operating on the same psychology as the paper market. The paper market waits for confirmation of the trend reversal before buying. The physical market accumulates on the way down because the structural deficit means every ounce bought today is an ounce that will not be available at tomorrow's price. And the cumulative deficit since 2010 is 580 million ounces. 580 million ounces of above-ground stock has been depleted over 15 years of annual deficits. The supply is not coming back. The physical buyers who understand this do not wait for $60 to buy. They buy what is available at the available price, because waiting costs them either a higher price or no supply at all. Here are the 3 specific scenarios for what happens when silver touches or approaches $60, because the honest version of this analysis must acknowledge that $60 is achievable and the investor needs to understand what that level actually means. Scenario 1, silver approaches $60 and reverses sharply. This is the scenario that produces the maximum pain for the waiting investor. Silver trades at 61, 62, 61.5, and then in a single session triggered by a catalyst, whether it is a surprise CPI reading, a Fed language shift from Kevin Warsh's June 16th and 17th FOMC debut, a change in Middle East ceasefire dynamics, or simply the exhaustion of paper selling pressure, silver gaps to 66, then 68, then 70 over 3 sessions. The investors who were waiting for exactly $60 were not short silver, they were on the sidelines. They watched the reversal happen. At 68, they say the bounce is a dead cat bounce and they maintain their $60 target. At 72, they begin to doubt the $60 target, but do not act because they still expect a pullback to 65 or 68. At 80, they have missed a 25% move from where they were willing to buy. This is not a hypothetical sequence. It is the documented pattern of how missed moves actually unfold in precious metals markets, visible in the 2018 to 2019 gold setup, in the 2020 silver setup, and in every other instance where the price approached but did not reach a heavily anticipated round number support level. Scenario 2, silver touches $60 briefly and reverses immediately. The technical term for this is a wick low, also called a false breakdown. The price trades briefly at or below $60, triggering the stop losses and buy orders accumulated at that level, and then reverses sharply as the activation of those orders creates a volume spike that overwhelms the selling pressure. In this scenario, the investor waiting for $60 gets their price for approximately 30 seconds to 30 minutes. Then the price moves away. Whether the investor successfully executes a buy at 60 depends on whether their limit order was filled, whether their broker's execution was fast enough, and whether the 30-second window at $60 was sufficient to process the trade and confirm. Many investors who have waited patiently for a price level for weeks find that when the price briefly touches their level in a fast-moving session, the execution is incomplete, partially filled, or the price moved before their order processed. They are left with a partial position or no position at a level they spent weeks anticipating. Scenario 3, silver breaks decisively below $60 and the cascade initiates. This is the scenario the bears are describing with their $58 targets. The Elliott wave analysis from FX Street published this morning points to $38.70 as the potential wave target if the $61 March low breaks. In this scenario, the investor who is waiting for $60 to buy into a structural bull market is buying into the beginning of a cascade that takes silver to 55, then 50, then tests the 40-year breakout level. The stop loss for a $60 entry in this scenario needs to be below $59.34, the December 2025 breakout level. The risk from $60 to $59.34 is 66 cents. The risk, if $59.34 fails and the full cascade develops, is potentially 15 to 20 additional dollars of decline. The $60 entry in scenario 3 is not the entry at the floor. It is the entry in the middle of a waterfall. Of the 3 scenarios, scenario 1 is the most likely because the structural supply deficit, the physical demand, and the institutional consensus all argue for silver being higher by year end from any level in the $60 to $64 range. Scenario 2 is possible and illustrates the execution problem with waiting for precision trading. Scenario 3 is possible if the structural thesis is wrong in its assessment of how much the UBS 80% deficit revision matters versus the physical supply depletion argument. Each scenario produces a worse outcome for the investor who waited for 60 than for the investor who bought at 63 to 64 with a properly sized position and a stop below the December breakout level. 3 things you need to understand about the current setup that the waiting for 60 psychology is making most investors miss. The first thing is the volatility asymmetry. Silver moves approximately 1.7 times faster than gold in either direction. This is not a theoretical multiplier. It is the documented historical ratio of silver's price moves relative to gold's. In a session where gold moves 1%, silver tends to move 1.7%. In a session where gold moves 5%, silver tends to move 8 to 9%. The session that triggers the reversal in silver will be a 5 to 8% up day. Anyone waiting on the sidelines for confirmation that the reversal is real will see silver at 63, then at 68, then at 71 before they can determine whether the reversal is confirmed. The entry available to the buyer who acted at 63 is not available to the buyer waiting for confirmation at 68. At 68, the confirmation is real, but the original risk-reward ratio has been compressed by $5 of missed upside. The second thing is the Goldman Sachs rate cut delay in proper context. Goldman pushing rate cuts to 2027 is genuinely negative for the near-term silver price narrative. But here is what it actually tells you about the macro environment. Goldman believes inflation will remain above target through the end of 2026, requiring the Fed to hold rates or potentially hike before cutting in 2027. If inflation is above target through 2026 and the Fed is holding or hiking at 3.5 to 3.75%, real interest rates remain negative for the entire calendar year. Negative real interest rates are the most reliably bullish monetary environment for silver in the historical record. Goldman's rate cut delay is simultaneously the most bearish near-term silver signal and the most structurally bullish 18-month silver signal. It says the pain continues and the structural case remains intact. The third thing is the China signal. The People's Bank of China has bought gold for 19 consecutive months. This streak does not end in June 2026 because Goldman pushed rate cuts to 2027. It does not pause because the US launched new strikes in Iran. China is accumulating monetary metal continuously, month after month, because the dollar's share of global currency reserves has fallen from above 60% to approximately 40%, and China is replacing those reserves with gold. When a sovereign wealth institution is buying the same asset class continuously for 19 months, regardless of price, the marginal paper trader who sells silver futures on a hot CPI print is selling into the most patient, most structural, most well-capitalized buyer in the world. That buyer is not waiting for $60. That buyer is accumulating every month at whatever price is available. The single most important practical insight from this analysis is not a price prediction. It is a positioning principle. The investor who acts at $63.95 today, with a defined stop below $59.34 and a risk budget calibrated to that distance, is taking a position with a specific and contained loss scenario and an upside scenario that every institutional analyst describes as meaningfully higher than current prices by year end. The investor who waits for $60 is delaying a decision by $4 in a market that can move 8% in a single session. The $4 of incremental price improvement that the waiting investor seeks is smaller than the average single session move in silver during periods of directional momentum. Waiting for $4 more of decline in a market that moves $8 in a day is not conservative positioning. It is false precision that creates false comfort while eliminating the flexibility to act when the move actually starts. The investors waiting for $60 are going to miss the move, not because silver is going to rally from 64 today and never look back. It might go lower first, but because the specific psychology of waiting for the round number has a documented history of producing the outcome described in the title of this video. The ones who wait for the comfortable number, for the additional confirmation, for the slightly better price, are the ones the historical record shows standing at the toll booth, holding their coins, watching the cars that already paid drive through. Subscribe because I'm covering every development in the silver market with verified, sourced, same-day analysis and telling you what the physical demand data, the institutional positioning, and the monetary signals mean for the actual move when it starts. Watch the next video because the specific mechanics of how silver's first major reversal session typically unfolds after a major corrective bottom, what the volume signature looks like, and how to distinguish the genuine reversal from the false breakout that traps the early buyers, is the framework that separates the investors who capture the move from the investors who watch it.